From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
It's Friday, July 12th. Welcome to the Macrocast. John Fagan and Brendan Walsh are here from Markets Policy Partners. I'm Tony Fratto from HPS. Last week looked like there was a lot of, surprise in the markets. This week, actually, when Chairman Powell testifying on the Hill, shorter dated Treasury yields, a dollar getting whipsawed, where people seem to be surprised that the Fed chairman is still dovish. And this is after last week's jobs report, where, I know a lot of analysts look at a lot of the bank reports and others seem to feel like maybe even a 25 BIP cut was off the table. I didn't feel that way, but people still seem to be surprised. What are they thinking?
Well, thanks, Tony. It was it's some of the surprise is really due to the challenging macro context for the chairman's testimony this week, and that's specifically referring to the surprisingly robust jobs number that came in last Friday. And I was on vacation last week. You all spoke about that in great length on last week's podcast, and very cogently and intelligently, I may add. So not to belabor that point, but it certainly whipsawed markets, and the upside spike in yields in the dollar that occurred on July 5th. Some of that was exacerbated by light liquidity on the sort of holiday shortened week, and trading desks not really being fully staffed. But it created this perception in the markets that the data had really helped the chairman coming into this testimony, and the consensus was that the Fed was getting a little uncomfortable with the aggressive rate cut trajectory that futures markets were pricing in. So before that jobs number, just for context, the futures markets had priced in, 100% chance of a 25 basis point kind of standard rate cut at the July meeting, but between 1 in 5 and 1 in 4 chance of a much more aggressive 50 basis point rate cut. And the rate cuts, the cumulative rate cuts to year end priced in were between 75 and 100 basis points. That's not insurance cut kind of pricing. That's a full blown easing cycle. And,
no question about it.
Yeah, and there was a sense, and certainly the chairman's commentary in late June sort of suggested maybe a little bit of hesitancy on that front. At the time, obviously the mantra was still act as appropriate to sustain the expansion. But Powell in late June said, whether the uncertainties they were pondering. He characterized the FOMC as pondering whether the uncertainties really call for additional policy accommodation. That seems a little non-committal versus where markets were priced. And you had Dallas Fed President Kaplan warning about premature rate cuts, and even the resident dove, St. Louis Fed President Bullard, characterized it very explicitly, suggested that a 50 basis point rate cut in July would be overdone, and so that led into that set the table for the market reaction to the upside surprise in non-farm payrolls. And so the consensus going into the testimony was that Fed Chair Powell, the data in the market has done the work for him. All he has to do is just repeat the mantra and the constant kind of act as appropriate formulation, and not really say anything new, and that would just keep expectations from getting too hot, and instead of pumping the brakes, he appeared to step on the gas and take a much more dovish line than people had expected, and explicitly and repeatedly downplaying the importance of that upside surprise in non-farm payrolls.
Yeah, I agree. I made when the number hit last week, and I tweeted out and said, so tell me the case for a rate cut now, and have we ever had a rate cut in this environment? And you can, there's some cases you can make, but they're not really macro cases, right? They're more sentiment cases based on the outlook. I mean, the macro cases, you're not hitting your inflation target. He talked a little bit about that the last couple of days at Humphrey Hawkins' testimony. Global outlook seems to be slowing. That's not new, though.
Right.
We've known that for a long time. It's just it is really it is hard to make a strong case, but I guess he did his best. Business investment tailing off, consumer still seems strong, but global growth missing the inflation target, headwinds from trade war. That's his story, and I would say, as we talked about before, and the market really wants it right now too. And now I think they can go away after one. And I think that's what they're gonna do. But he made the best case he could make, I think.
Yeah, I think, and really, some of this really is down to a communications issue and the way that the markets have consistently taken taken what the Fed has said, and maybe added a few rate cuts on top of it. As some commentators have said, the Fed giving an inch and the market taking a mile, and we did see a very quick snapback right off the bat at the start of Wednesday's testimony when his published remarks were out. The market basically the July. The market implied odds of a rate cut, of a 25 basis point rate cut in July, never really went that far below 100. They went down into the lower 90s after the jobs number, but kind of elevated back up. But it was really the expectation for a 50 basis point kind of shock and awe beginning, that went to zero. Those implied odds.
I just thought that was crazy, though.
But now they've snapped back. The chairman basically waved the red flag. I mean the red cape in front of the charging bull of the Treasury's market. And that those odds snapped right back. So after his testimony, they went from zero and reverted back to about 1 in 5 this morning. We saw about 1 in 4 before the CPI numbers. So
I never really understood the expectation on a 50 basis point cut. I just thought, in fact, if they went to a 50 basis point cut. And if they would do that, I think they would scare the markets. I think they would scare all of us that they see the economy much worse than we do, that they're much more concerned. So rather than shock and awe, I think it would signal that they're very concerned about the economic outlook.
Still is that sense that the Fed gets more data and information than the general market and population. So I totally agree that a 50, while maybe in the first couple of days people would take it well, they might digest it and say, oh, wait a second, what's going on here?
And then they'd have to talk it off,
Right.
if they don't believe it, then they'd talk it off. And if you do a 25 basis point cut, you leave room to do it again if you want to, but you're also talking about fine tuning, not that you think there's something fundamentally wrong with the economy. And I think 50 basis points just sends, that's the signal it sends, is we think there's something wrong here. John, the difference between Chairman's testimony on Wednesday and Thursday we got CPI, gave a little bit of a different backdrop to his testimony on Thursday. What did CPI show us?
Yeah, well, CPI created some unhelpful optics for the Fed chair, who had spent obviously the first day talking a lot about downplaying the strength, how the strength of the labor market can feed through to price pressures, how the downside risks to inflation and so forth. And he was repeating those cases. On Thursday, the CPI data for June came in a little bit hotter than expected. Now, nothing that's scorching or overheating kind of level, but the core was up 0.3% from May, which is the largest month-on-month increase since, what was it, Brendan? Since January of 18?
January 2018, and now it puts it at 2% year over year, which is, they use the PCE core price index, but if you extrapolate from the core to the PCE, it looks like the core PCE for June will accelerate also to 1.7% year over year. And a lot of those factors that a few months ago that Powell cited as transitory, really in this CPI showed up as transitory. So it's kind of a weird dynamic that he has. He was actually correct a couple months ago, and then he kind of changed his mind.
And the ensuing sell-off in the longer dated Treasury bonds was exacerbated by a 30-year bond auction, Treasury bond auction, that traders characterized as disappointing in the afternoon, and we ended up seeing 10-year yields having a pretty chunky increase, going up about I believe it was about 7 basis points yesterday, into not eye-watering highs. We're still at 2.14% when I last looked, but that's the highest in the highest since May, and certainly is created some snark in the financial community as when it as the Fed chair was holding court about the risks of downside inflation and the data.
Tony, I think the details of this CPI report kind of illustrate your point on inflation, where we get a little too caught up in tenths and month over month. Where the service part of the CPI is running well above 3%.
Yeah.
Where goods are flat to negative, and it kind of balances itself out to below 2%. Yeah. So but a lot of the goods inflation is going down because technology is improving. It's a positive result, not something necessarily that monetary policy can have a large effect on.
And one of the other things that we got yesterday was we've heard certainly from the regional Fed presidents. I mentioned Dallas Fed President Kaplan earlier with a much more balanced formulation, warning about the risks of premature easing and so forth. And Atlanta Fed President Bostic and Richmond Fed President Barkin both yesterday came out and made similar remarks about the difficulty in their view of justifying a rate move in either direction. I don't think that's going to change the dynamics on the committee, but it does indicate at least a modest diversity of opinion, and the case, and it highlights that this, the market is pricing in a slam dunk easing cycle through the rest of the year, and it's not necessarily clear that that's the case.
Yeah, I don't think that's. I think they'd be wrong on that if that's where they're heading. Lael Brainerd was out this week also with indicating more accommodation, but I don't see it as a cycle unless we do see more data saying that we see that we actually see a slowdown or signals in the upcoming months from non-farm payrolls.
I think the trade is a massive wild card in this, where if we do kind of de-escalate with China, we get a cut here. The second half of the year could really accelerate, and the bond market could be massively offsides, where people are thinking now like we're going to go to 1% on the 10-year. We might in that scenario be going back to 3%.
I think they're dreaming. Yeah, no, you're right. Yeah, that's right. I think they're
right.
That's what their baseline is. I think they're dreaming, and but there may be other. Look, always as we see, even month to month, we've seen over the last 3 months, pretty significant shifts in views on the outlook for the economy, and because of some of the big data prints. But we're getting some other signals, which I want to go to in our next segment, which is what we're seeing from on the corporate side, earnings. Love to dive into earnings. Why don't we take a break right here? You're listening to the Macrocast. I'm Tony Fratto with Hamilton Place Strategies, John Fagan and Brendan Walsh with Markets Policy Partners. We'll be right back.
You're listening to the HPS Macrocast. Every Friday, we take a look at the major economic trends of the week. See more from Hamilton Place Strategies at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, we're back on the Macrocast. Brendan, second quarter earnings reporting season kicking off. Big banks and corporates are going to be out there. What's the outlook for the quarter?
Yeah, so the week starts off with the big banks. Yesterday, we actually had an industrial, Fastenal, which gave kind of disappointing earnings and guidance, and it was heavily related to their imports from China due to the tariffs. So the market will definitely be on edge to see how much effect that's having on the industrial sector. But for the next week or two, it's very heavily financial related. So the expectations actually for the banks for the second quarter earnings are actually quite good. They're supposed to be up about 4.5%. But the actual earnings will kind of be secondary because of exactly what we just talked about with the rate outlook. So if rates the Fed's going to cut a few times and rates going down. That's not particularly good for a bank who borrows at the short end and lends at the long end, and their net interest margins are going to be condensed. So that's kind of the outlook. So these earnings will be much more focused on the calls and the commentary from earnings and management. And the one that everyone kind of pays the most attention to is J.P. Morgan. And, Jamie Dimon kind of has a cultish following, and it's very deservedly so.
Yeah.
So we'll see if he's on the call. A few years ago, he kind of stepped away, and he doesn't do each one of them. I think because of that, because people are paying too much attention to every adjective that he said. But I wouldn't doubt that he wouldn't come on this call and kind of give his outlook for the economy.
One of the things
there's always a little bit of gaming on the, on earnings. I mean, a lot of people slash their earnings expectations.
Exactly.
But
very rarely does anyone miss, because the IR in investor relations gives guidance, kind of a month into all the sales side, and they cut their estimates, so everything's kind of within spitting distance.
Yeah,
so,
there's always. I mean, there is some gaming there, but there are some signals. I mean, one of the things that we do at HPS is we go, we look at transcripts from earnings and try to analyze them and see what what are the trends, what do they mention? Are people worried about trade? Are they worried about the Fed? Or we look for those kinds of signals across all the firms, and there is certainly an uptick on trade, and we'll get into that later. But the consumer still seems to be strong. I haven't heard yet, and heard even in the lowering of expectations on earnings, concerns about where the consumer is right now.
Exactly, both from consumption side and also from credit side. So no bank, whether it's a subprime lender or a prime lender, has really expressed too much concern, other than little niche markets. And then when you look at, overall consumption, if Sears isn't doing quite well, but Amazon seems to be doing fine.
Yeah, and some of the analyst commentary on Wall Street is that the downgrade and the guidance downward, the pre-announcements going into this earnings season have been concentrated in the industrials. And as Brendan mentioned, Fastenal, which is an industrial fastener, I mean, they're in a lot of different products. And so they're a terrific bellwether for the industry. It was telling that they missed both sales and profit estimates. And the stock opened up pretty sharply down and then rallied all day. And it closed down to almost 3%, which is not a great day by any stretch of the imagination. But the stock has been down, and the rest of the industrial sector stocks rallied yesterday, which is indicative of some of the other commentary you get from analysts, is that some disappointments and some rocky numbers are priced in. People are coming into this earnings season without really lofty expectations in a lot of different places. The year-on-year comparison is very hard. So overall, the S&P 500 companies for this quarter are looking at a negative 2.6 or 2.7% earnings growth year-on-year, which is which isn't all that inspiring. But it's really more about the the year-on-year comparison after last year's sort of tax-fueled earnings boosts. So when the rule of thumb is that when expectations are pretty muted and sober for an earnings season, it tends to be easier for even sort of lukewarm results to be supportive of stocks. It's the surprisingly bad earnings season that catches everybody off guard. That tends to have.
And the S&P on forward guidance, forward earnings is trading at 17.5 times, which is at the higher end of the historical. But that's just if you look at it standing alone. When you compare it to where rates are, it's actually not that expensive.
And we're here looking at record highs on the in the S&P right now. So it doesn't seem like investors are worried about what they're seeing from the corporate sector.
Yeah, it'll be interesting to see how this earnings season plays out, and if you do have, there are always a few surprises, both the upside and the downside, and so we're going to be watching with great interest how the main narratives play out, and certainly, as you said, a lot of it is going to be focused on trade and the outlook for the second half.
One part of that narrative, I said we're going to get into this, and so one part of that narrative. And I think we are going to see lots of evidence of this in earnings. A lot of commentary and concern around it is just where we are with our trade relationship with China, and just as a gift to our podcast, the president tweeted out this morning, how much he loves. How much he loves tariffs. They're great, and they're bringing all kinds of money into the Treasury, and that we would have kept our auto sector in the United States if we had higher tariffs. So a very pro tariff stance, which we always knew, right? I mean, there was a lot. There were a lot of sort of free trade people around the president who would always try to rationalize his pro tariff remarks by saying, he really sees them as a means to an end for free trade and trade liberalization. And I think people are just going to have to come to grips with the fact that that's not really the case. He likes tariffs. He's told you he's a tariff guy. And so my question is, again, thinking about earnings and corporates, they haven't gone. I don't know that they expect that where we are with tariffs right now, tariffs on China and maybe other potential tariffs are going to stick. Was it in their base case that these tariffs are going to be around for a long time, or that they may go away in the future? And if I were advising them, I'd be telling them, you better buckle up for the expectation that they're going to be here for a while.
I think that's increasingly aligned with the consensus that we're hearing, and there may be some optimism that there's certainly optimism that tariffs don't escalate from here, and the trade talk reset at the G20 at the end of last month after the summit between Presidents Trump and Xi really allowed market participants to take trade and put it on, as much on the back burner as it could be at this point in terms of reacting to the headlines, like tweets and the daily drip feed of commentary from Chinese officials and U.S. officials about how how the negotiations are going and the progress and and this sort of thing. A lot of that is going to market participants are going to be obviously monitoring it, but it's going to be fading into the background noise to some extent unless something really material changes, and that's largely due to the fact that there were no deadlines put in on the reset. It wasn't as though President Trump said we need to have some progress on the talks by the end of September, or that next tranche of 25% tariffs on 300 billion of Chinese imports will be applied. That is, there were no deadlines, and so everybody's assumption is that this is going to be dragging on for quite some time. And as you said, the game changer really would be if corporates come out and say that the impact from the tariffs as they stand right now are much more virulent than market participants had previously expected, and that's leading to a considerably darker outlook in the second half of the year. That's possible, but that would be, absent that, I think market participants are going to be, living with the idea that these tariffs that are currently in place are going to be hanging around for a while.
Yeah, so look at Larry Kudlow, National Economic Council Director Larry Kudlow, said maybe we'll never have an agreement with China, and. Larry says a lot of things, but I think he kind of means it. Maybe they may never get to an agreement with China, in which case the tariffs that are there are going to stay there. They're not going anywhere.
Yeah, and it's from the investor perspective, that's if your corporations are able to, and Fastenal's management really spoke to this. They said, look, we're trying to raise prices to account for some of the tariff friction, some of the increased costs from our supply chain. We haven't been able to raise prices fast enough. to do that, or effectively enough to offset these, and so we're having a narrowing margin situation. I think that's something that corporation, that we're going to be hearing a lot of from different, particularly industrials. But the question is, does it get? I think that the question for investors is, how much worse is it going to get? And is this something that management is going to be, able to absorb, able to, finesse, able to, move their production to Vietnam or whatever it is, and, at least come back to a, an arrangement that is, that's roughly in equilibrium with where they are right now, and I think, or is the situation going to just continue to get worse? And I think that right now, looking where equity markets are, they believe it's the former, that we're sort of in this new equilibrium, and corporations are going to be dealing with it, but that it's not going to get much worse.
All right, why don't we take a break right there? You're listening to the Macrocast. Tony Fratto with Hamilton Place Strategies, John Fagan, Brendan Walsh with Markets Policy Partners. We'll be right back.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
We're back with the Macrocast. Brendan, any conspiracy theories for me?
Yes. It's not quite a conspiracy theory, but there is a narrative going around Wall Street now, and it's driven by the president because he said it, that the Treasury might intervene in the FX market now that, every other central bank is weakening, and also China, he says, fixes their currency. What do you think about that, and what does it mean to intervene?
I don't know. The dollar's definitely strengthened. The president doesn't like the dollar. Again, we always have this weird situation where the president, he's named as National Economic Council Director Larry Kudlow. Larry Kudlow famously every night on CNBC would talk about King Dollar, right? King Dollar, strong dollar. He keeps nominating or threatening to nominate people to the Fed who are dollar hawks, gold bugs and dollar hawks. But he is very, very clearly someone who thinks, you can devalue your way to prosperity, and keeps pushing for it. And so he's been trying to jawbone the dollar lower, and also wondering why the Fed isn't doing more to weaken the dollar. And so then there's been this talk about potentially intervening. It's hard to intervene if you're in the United States. I mean, you can try to do it. There are a couple reasons why you wouldn't. One is just that you encourage other countries to do a whole lot more intervening, and we put out a Treasury report every year about currency manipulation with our major trading partners. You could tear up that report if we start intervening to lower the value of the dollar in order to gain a trade advantage. That's specifically the point of that report, is to discourage that kind of activity, and so then we would be out doing it. That's number one. Number two is that I don't even know how big the dollar forex market is right now. It's measured in the multi-trillions of dollars a day of transactions in dollars. We don't have that much. We don't have as much money. We don't have very much money to go and really impact it. Now the Treasury could go and intervene and signal that maybe it has intentions to do more, and maybe that might be enough to take some enthusiasm for the dollar off. But I just don't think so. I think that there are the reasons for why the dollar, the value of the relative value of the dollar are what they are impacted by massive global forces that are really hard to affect by jawboning or by using the little pop gun amounts of money that we have in the exchange stabilization fund. I just don't think you could do very much. The flows, financial flows and trade flows are just far too massive, and they are impacted by by other real sentiments and real economy kinds of needs, and they're hard to move around.
Yeah, I think you make a very good point about job owning. It's it's relatively costless, a relatively low risk strategy. It's like shooting your mouth off in a bar. But if you actually have to back it up with action, it's a much more dicey prospect. Worst in general, when FX desks see overt intervention in a currency, that's very often a signal where they're going to, in the next investment committee, they're trying to figure out when exactly they should bet against that intervention. What's the half-life of the impact of an intervention that they know can't be sustained? Now, obviously,
it's short.
Yeah,
it's really short. You could trade the news on a given in 15 or 20 minute increments on that. I mean, if the president comes out and says something strong, I think you'll see some movement, and if you can execute those trades really quickly and get in and out, you can probably make a little bit of money. But I've never seen job owning have much of an impact, in not just in the United States, but even in the kinds of Japanese used to try to do it all the time, and of course they sometimes have a little bit more influence with their central bank that can have a little bit of an impact, but it's just really hard to do. These markets are just too big.
Yeah, and certainly within the U.S., the potential for intervention. The U.S. obviously does not intervene directly in currency markets very much. Right. Just speaking in generalities, the institutional apparatus for them to do so is clunky. It's a jointly managed account between the Treasury and the Fed, which raises complications. It's also very politically charged in past instances when they've used the Exchange Stabilization Fund. It's drawn a pretty adverse reaction on Capitol Hill. And it's probably one of the things that's better to threaten rather than actually to try to put it in play. But as you said, I mean the market impact. I mean, you need a microscope to look at the impact on the dollar with this kind of job owning, even from the president. That was there's a much more lasting and substantial impact from the data and from Fed action. There's maybe there's obviously a sense on among FX strategists that might change if basically the White House and the Trump administration come out and explicitly garbage can the strong dollar policy, which they haven't done so quite so explicitly, and I think that would be. There's a potential for a sea change there. I don't think they've gone down that direction. There's, reports indicate that Treasury Secretary Mnuchin and National Economic Council Director Kudlow are not enthusiastic about the idea of intervention, and I certainly take that side of the argument.
All right. Well, why don't we leave things there for this week? I think I think we're going to have a little bit of data to look forward to next week. Certainly earnings, and we may try to spend a little bit more time on what we're hearing on earnings next week and see how that plays into expectations for the next quarter, and then looking ahead to actual FOMC meeting. So, John, Brendan, thanks. We'll talk to you next week. This is the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.